Okay, so very good morning. Welcome to the briefing for Monday, the 27th of June. I defy anyone who can say they did not read anything Brexit related this weekend. I think it was very hard to get away from it. Every single newspaper was literally start to finish talking about the issue. The movement we saw in the market, obviously through Thursday night, Friday. I'm not sure if any of you are on Facebook, but wow, some of the slagging matches going on Facebook at the moment are impressive. But state of play this morning is we're still very much trading in the aftermath at the moment. I'll get on to the whole week calendar shortly in this briefing, but one interesting thing is that there's an extremely busy calendar actually of economic events coming out this week. But I do very much believe that this whole Brexit and what does it really mean for the financial markets, and more importantly at this stage politically, how we're going to tackle it, really is the most pertinent subject at the moment. And I think that's going to dominate the market, not just this week but for the weeks to come. But particularly the political element. From having not heard from the Chancellor George Osborne, he literally disappeared off the face of the planet from Thursday night. He has re-emerged and he is alive. He gave a speech on Bloomberg TV this morning and to the broader public, essentially saying that he's not going to call an emergency budget, and also talking about this Article 50, about when that's going to be triggered, and then we'll get into that in a bit more detail shortly. But first of all, just take a look at the state of play with the assets then, kind of epitomising the overall change in some of the major assets and the flight to quality. You know, for any of you new guys, if you wanted to see the most kind of clear price movement of a flight to quality move, then look at gold and the yen, and then against the British pound. You know, you can see this massive divergence now seen between the two, all coming on the back of that latest event. The pound still taking a bit of a hammering this morning. We're down just in excess of 2 points, trading at 134.46 at present price. If I just take a look, we got the pound here, top left. So this encapsulates this chart here, the actual fall that we saw throughout the evening of the local authorities reporting. Obviously Newcastle, Sunderland, that first wave lower, Swansea, then as we got around 3:30 in the morning, we saw that next flush through 140, which ultimately led to one of the biggest intraday moves on record. Looking where we are at the moment, so just marking this up, we were trading obviously 150 pre the results, and to where we are at current market price, we're still down around 10%. But just off those initial lows, to keep an eye on, I guess, next downside around that 32.50 type level. Again, looking more longer dated, I guess on the upside, we're trading 34.48. We'd be looking at that 38.35 as next kind of resistance. And you know, when we're talking about price movement in the pound at the moment, you know, you must be aware of the size of these moves. You know, we're used to seeing on a normal day anything from around, I'd say, a 50-70 pip range is a fairly decent day. Whereas now, you know, to be calling levels up at 38.35 on an intraday, and whether we'll test that, which is like 300 pips away, you know, it's not to be ruled out in these kind of market conditions. Now, above there, obviously 140 is quite a psychological level. It held up as various support throughout the months of Q2 in particular of this year, so that'll be the next kind of level as well to watch out for. You know, in terms of real money terms, I'm not sure if you're all aware of the actual size of the impact on the equity market in particular globally, in which the Brexit caused. So the pummeling of the pound and the high yielding assets, they were hit more than $2.5 trillion was wiped off the global equity market in terms of value. 2.5 trillion. Now that's the kind of the movement that we're seeing. One of the key things, I think, though, And one thing I found particularly interesting is that at the moment, I'm not getting a great sense of panic in the market. And I think this is a real key difference from what I felt when covering the 2008, the kind of subprime crisis and the collapse of Lehman Brothers. Because at that point, after they collapsed, every day and every week and month thereafter, pretty much, there was such uncertainty in the market that the volatility was persistent daily, every single day. The market was getting hit, bounced, hit. The volatility was extreme, and we're not really seeing that this time round. And I think that you have got to go some way to say that the central banks have done a fairly decent job, as much as it pains me to say it. They've done a fairly decent job in actually shoring up the capital on some of these banks, ensuring that there's enough liquidity in the system. We heard the Bank of England say that they're basically giving banks the option of a further £250 billion of liquidity if it's needed. And I think it's these types of things which has negated a lot of the volatility thereafter. I'm not saying 200 pips in the pound isn't a lot, but any of you who traded through, obviously at 08-09 period, there is a quite eeriness of calm around the market at the moment, which I think is quite interesting. From a statistical point of view, after the pound saw such a dramatic fall, it's quite interesting to look at, what's the next day's performance after such a big move. And I saw this in the FT, I thought I'd share it. It basically shows the fall of the pound, as we saw on the 24th of June, 8% was the actual closing level. And then looking at the next day's performance. So you can see that, generally speaking, there's a couple of greens there, especially around the subprime era, of where when price movement gets to its most extreme point, then obviously we quite often see quite sharp snaps back. Before then, the trend might resume, and the prevailing move might become obviously negative for sterling at the moment. But the days after, it's important to put in context the scope of the move and any ability for potential pullbacks. Looking at the latest political state of play then. So as I said, we've heard from Osborne. So he's not resigned, which I found actually quite surprising, given the close alignment with David Cameron. I guess that with both camps, Leave and Remain, what you do need for sure is at least some degree of continuity, particularly with someone who's the most up to speed with the financial situation in the UK. So it makes sense to keep him in place. He has said, as much as other politicians at the weekend, particularly on the Leave side, that they don't want to trigger immediately Article 50 of the Lisbon Treaty. Remember, that's the key one for then the 2-year negotiating period to commence, and therefore the exit of Britain. Now, the European officials, if you read any of that at the weekend, are super keen to get that underway. I think it was the head of the European Parliament, Scholz, and other founding members of the Euro have all been pretty vocal that by tomorrow, when some of the European ministers meet, they want the UK to trigger that and put it into effect. Because ultimately it means then that they have a greater degree of leverage to negotiate and put Britain in a more uncompromising position that will have to accept their terms. On the contrary, though, Britain is saying that until we have an in-place succession plan for David Cameron and the Conservative Party and the political landscape domestically, then why would we push that button? Again, it is up to us as a country to do so, but I would be expecting pretty aggressive comments today and the coming days from Europe to try and pressure us into making that move. I don't think we will trigger it, though, anytime soon. Not at least until we have some clarity over who will take over as head of the Conservative Party. As you've probably read, Boris, still the favourite. However, the probability of that has dropped. And Theresa May is actually the second, followed by Gove at present. You've probably read as well the opposition party, Jeremy Corbyn's come out very unfavourably over the weekend. There's been a whole group of Labour ministers who have all handed in their resignations kind of a lack of confidence within Corbyn, so his job's probably under pressure and he'll likely leave as well, so just adding to the mix. One silver lining though from a political point of view that I have seen over the weekend is Spain. Now if you look at Spain, they were in fact the hardest hit in the wake of the Brexit. On Friday, their stock market fell 12% at the close. We actually managed to see a bit of a bounce in the likes of some of the other European indices, but Spain was down 12%. That's because they had elections on Sunday. And if you look at the Spanish market this morning, we're actually trading positive, outperforming in Spain. Although there's probably a bit of profit taking now that event has gone, it's because the actual event itself, I guess worst case, averted. So the country's second general election in 6 months saw the ruling Conservative Popular Party increase its vote share. So Spain, if you remember, has been without a government since December of last year. But yesterday's election saw falling support for the far-left coalition, Unidos Podemos, who were the third largest party after the mainstream socialists, who came second. So it does point to a bit of a fresh round of electoral stalemate, no party gaining enough seats for a majority, but at least, I guess, as kind of one more hurdle out of the way on their route to trying to form a cohesive coalition. So Spanish market's actually up. Now, we have been talking a lot about contagion. And I think now this is really important because for the moment, short term, for the UK, it's about getting our house in order to who's going to leave the country. But looking at risk assets such as gold, which I'm looking at here, you can see the monumental jump that we saw on the day of the vote to leave. It went from around 1270 type levels all the way up to almost 1370, around $100 move. You're looking at the moment, we're still holding on to around 2/3 of that, trading at 1330, up $7 this morning. Now, Italy is someone I think that the market is very, very nervous about. This is because they recently had their municipal elections, and the Italian 5-star movement, which are Eurosceptic, came out particularly strong. Now, just reading one of the Deutsche Bank notes this morning, they've said their view is that Italy has the potential to pose a greater medium-term challenge to the euro area's stability than Spain. Increasing Euroscepticism and growing support for the anti-establishment 5-star movement would raise the probability of a constructive, legally non-binding referendum on the euro in Italy, especially if the Senate reform is rejected. On similar points to this as well, I've also read reports about Austria, talking about, if you remember, the presidential race in Austria, very close, and one of the most right-wing politicians in recent history only lost out by a fraction. Now, he's been calling at the weekend that they want a referendum as well. So you've got, a bit of a rising in this kind of Eurosceptic parties, so the likes of Italy, Austria, definitely to keep an ear on going forward. The other thing as well, my wife is Northern Irish, and I'm not sure how up to speed you are about the history of Northern Ireland and the peace process, but she lives or her parents, in a very Protestant area. It's called Craiger Road, and it's a road where the Orangemen march in July every year. And as you know, the Orangemen, they are, they kind of epitomise the Protestant fraternal organisation. Now what's going to happen is Ireland are going to have this push to unite the country. This is going to cause massive, and I think violent, reaction in Northern Ireland in particular, irrespective of the financial state that this move will have on them. So soon as it starts getting violent, and the reason why I mentioned the Orangemen is because they have their march coming up in a few weeks' time. If that starts to get violent and it starts to get covered on TV stations, not just in the UK and Europe, but across the US news services, given their kind of probably lack of understanding of the peace process there, I think these markets are going to get seriously volatile again with a very negative reaction. Because as we saw with Greece, when it started to get violent, that's when the US really started to take hold of the situation and view it very negatively. Okay, UBS, most of the investment bank research that I read this weekend was not talking about spike in prices, on the fact the pound weakens so much that it's going to fuel prices. I think that's going to be more of a one-off shock. Most investment banks are talking about the effect this will have on the slowing of growth. It's going to have a wide-ranging impact across the economy. This morning I've already seen, well, I'm sure this will probably make more people happy given people's dislike of estate agents, but Foxtons down 18%, profit warning. EasyJet, profit warning, down 10% this morning. People buying high-ticket, London properties, all going on holiday, is certainly on the back seat, prompting these types of profit warnings this morning. We're going to have weaker growth. That's pretty much the broad consensus. So if we have weaker growth, we have a lack of confidence, people in spending, that's going to mean that the Bank of England most likely are not going to cut rates this summer. Probably reignite then quantitative easing. I'm sharing with you here, this is UBS's view. They're looking at a BOE rate cut of 50 basis points likely August, November. Bank of England restart QE. The Federal Reserve, we talked about that last week. A rate hike for this year now, for me personally, is off the cards. It's not going to happen. You cannot raise rates now. September is too soon. Then you've got the US elections. There's just too much in the way now, I think, for the Fed to really act. Just taking a look at the response then, what we see for ECB, because this is also important. And this is what I've seen from Deutsche Bank this morning. Potential ECB policy responses under Brexit scenario. One thing here is that a deposit rate cut, I think, is a lesser chance of that happening. If you think about the amount in which banks fell on Friday, you had the likes of Barclays, RBS down over 30%. The last thing these banks need is a lower deposit rate to kind of put pressure on them in these already pressured times from a central bank. And that's also the last thing I think that the ECB will want to achieve. What I do think, though, what will happen, which we've already seen from the Bank of England, and the ECB have also reassured the market, is additional liquidity into the system and verbal intervention. Now, one thing is there's a meeting going on in Europe. The ECB, they're hosting a 3-day meeting in Portugal, which includes Draghi and also Janet Yellen. I'll be expecting Draghi, who speaks later on this afternoon and tomorrow, to continue to use very strong wording of, we'll do what it takes, we'll continue to provide liquidity, we're monitoring the system, and we stand ready to use every tool necessary to stabilize the system. That's the language I'm very much expecting. The other things, other than on a slightly longer term basis, if the situation does deteriorate, particularly in the peripheral markets, i.e. Italy and Spain, is QE time extension and also more targeted long-term refinancing operations, probably a broadening of the quantitative easing program in Europe. Let's not forget, it's only just started in practical terms. So there's a lot of other things you'll think that the ECB can do. I certainly don't think it's panic from an ECB point of view. This talk of helicopter money, that's a long way down the road for me in terms of the ECB. Just taking a quick look at the calendar. Today there's really not a lot going on. So really it's going to be a sentiment-driven day by how the market interprets. Now it's had a bit of time to catch its breath on this whole Brexit situation. Showing you though, things certainly do get quite interesting. This notation at the top, just so you're aware, non-farm payrolls is not this Friday. Non-farm payrolls traditionally is the first Friday of every month, but however, the first Friday of this month actually is the 1st of July. So not enough time for the agencies, the Bureau of Labour Statistics, to calculate all the necessary statistics. So that's been pushed back to the 8th of July. So no non-farms this week. But As I mentioned, you've got Draghi speaking today and tomorrow. You've also got Janet Yellen on Wednesday. That's that three-part ECB meeting. You do get a lot of US data this week. You've got the final QI GDP, consumer confidence. You get manufacturing data as well throughout the week. All of these are tier 1 economic data releases. However, at this particular point in time, as I said, rates in the US are definitely not going to rise this year. And even a question mark over 2017 at this point, given there's still a lot of things we need to know before we can make those assumptions. And as such, US economic data certainly has taken a bit of a back seat. The only thing I could think of is if the data is very weak, then that's only going to fuel arguments for more kind of stimulative policies across the major central banks. Likewise, Friday kind of accumulation of all of the manufacturing PMIs globally. That does include China as well. Let's not forget about China. If you look at the overnight trade, some fluctuations in the yuan fix again. You've got manufacturing data at the end of this week. If China starts to become problematic as well, and this idea of potential hard landing re-emerges, coupled now with this political uncertainty emanating out of the UK, then these markets, gold prices, further weakness potentially in equity markets, and the prevailing flight to quality could well be an economic theme, not just now, but for the next couple of months for sure. Okay, I think that kind of wraps up everything this morning. So overall, very much markets still in digestion of the news from last week. The pound has been speaking, come back down to 134. I guess the initial downside levels to look for are the first spike lower that we saw in the wake of the referendum itself. The language we're likely to hear from the likes of Draghi this afternoon is going to be very much on the reassuring of the markets that they stand ready to do what is necessary. Further liquidity injections, that's probably going to be the most normal step that they'll take at this point. Okay guys, that's the wrap. I'll be on the chat as normal throughout the day, so please do ask questions if you should have them. That calendar of weekly events, I'll also get Bill to send that out with the strategy later on this afternoon. But thanks for listening, and as ever, have yourself a great session. Thank you.